All right, welcome to this explainer. Today we're tackling a massive, highly critical area for chartered accountants, tax pros, and business owners. We're talking about Section 119 of the Income Tax Act 2025. This is the absolute cornerstone when it comes to restricting the carry forward and set-off of losses, and it's a compliance pillar you absolutely need to master.
Let's kick things off with a real-world scenario. Say you, or maybe your client, buys a closely held company. And this company is sitting on a mountain of accumulated tax losses. You're probably thinking, awesome! Do these losses just automatically transfer over so I can slash my future taxes? Well, the tax law totally sees this strategy coming. And the short answer? Absolutely not. So how exactly does this work? Here's our game plan. We'll quickly cover the legal provision, dive into a detailed explanation, walk through a concrete practical example, hit the vital compliance points, look at some common real-world issues, and then wrap it all up with a quick summary. Part 1. The legal provision. Let's look at what the law actually intends here. Section 119 of the Income Tax Act 2025 is basically your definitive rulebook. Its main goal? To stop tax evasion. Specifically, it's designed to kill the practice of trading in losses. You know, when a highly profitable company buys a failing, loss-making entity for the sole purpose of eating up its tax benefits. To stop this, the law aggressively steps in the moment there's a significant change in ownership or structure. And it zeroes in on 3 very specific scenarios. First, a change in the constitution of a partnership firm under Section 119(1). Second, a succession in business under Section 119(2). And third, which is probably the one you'll see most often in corporate practice, a change in the shareholding of closely held companies under Section 119(3). Moving on to Part 2, detailed explanation. Let's unpack how this actually applies on the ground, starting with firms and successions. For partnership firms, if there's a change in the Constitution, Section 119(1) lays down a strict rule. You cannot carry forward the proportionate loss share of a partner who retires or passes away. That specific chunk of the loss, it's just gone. It expires. Then, for business successions under Section 119(2), the general rule is equally tough. The new successor cannot carry forward the old predecessor's loss. But there's one massive exception you need to know. If the succession happens strictly because of inheritance, then yes, the loss can actually be carried forward.
Now let's talk about closely held companies. 51%. Keep that number locked in your head. If you're advising a private company, this single metric is the difference between millions in tax savings, surviving an acquisition, or literally vanishing overnight. Here's how the mechanics work under Section 119(3). A closely held company, meaning one where the public isn't substantially interested, can only carry forward and set off its past losses if it passes a super strict continuity test. The shareholders who beneficially held at least 51% of the voting power on the very last day of the tax year when the loss happened must also beneficially hold at least 51% of the voting power on the last day of the year you're trying to set it off. It's a continuous test. If that 51% beneficial ownership chain breaks, boom, the right to set off those prior losses is completely wiped out. For the veteran tax professionals tuning in, let's bridge the gap between the old and new regimes. Under the 1961 Act, you probably knew this rule like the back of your hand as Section 79. Well, under the new Income Tax Act 2025, Section 119 seamlessly continues that exact same architecture and intent. So the core principles you've always applied, they are fully intact and directly ported over. Let's jump to Part 3, practical example. Let's see exactly how this continuity test blows up a real-life corporate deal. Okay, picture this. It's year 1. Mr. A holds 60% and Mr. B holds 40% of the voting power in XYZ Private Limited. That year, the company takes a massive business loss. Now, fast forward to year 2. Mr. A wants out, so he sells his entire 60% stake to a brand new investor, Mr. C. Mr. B just keeps his 40%. Here's the problem. Out of the original shareholders, only Mr. B is left, and he only has 40% of the voting power by the end of year 2. That means our 51% condition fails. The strict consequence? XYZ Private Limited totally loses its right to set off that huge year 1 loss against any year 2 profits. Now, there's a really critical nuance here regarding transition rules from the old Act to the new 2025 Act. If you check the official transition FAQs, Section 536 of the new Act does protect those pre-2026 losses, but there is a massive catch. This protection only kicks in if the original loss return was validly filed within the due date under the old 1961 Act. Timely filing under the old regime is your absolute golden ticket to bring those losses into the new regime. All right, part 4, compliance points. Let's talk about how you actually protect yourself and your clients. This is where the rubber meets the road. First, maintaining crystal clear share registers that prove beneficial ownership on March 31st of every relevant year is completely non-negotiable. Second, as we just saw, you have to be obsessive about due dates for filing loss returns. Third, you've got to keep airtight audit trails whenever there's a business restructuring or amalgamation. And finally, if a succession happens via inheritance, document it explicitly. Otherwise, you won't be able to claim that exemption under Section 119(2). Moving to Part 5, common practical issues. What are the traps people fall into? One massive pitfall, and it's explicitly called out in the official FAQs, is assuming the new 2025 Act can somehow magically fix your old mistakes. It absolutely cannot. If a taxpayer filed their loss return late for, let's say, assessment year 2024-25 under the old 1961 Act, that loss is permanently frozen. The saving clause in Section 536 of the 2025 Act preserves valid losses. It does not resurrect dead, ineligible ones. Part 6, Summary. Let's lock in everything we've covered today. Here are your main takeaways. Section 119 is all about stopping loss trading during ownership changes. For firms, you lose the proportional loss of departing or deceased partners. For successions, you can't use predecessor losses unless it's an inheritance. For closely held companies, always run the 51% continuous voting power test. And for transitions, validly filed old losses are safe and perfectly preserve their original character. So before we wrap up, ask yourself, in your client's next big merger, have they actually factored in the true tax cost of forfeiting those accumulated losses? The math on that could literally change the entire deal. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.